Thank you, everyone. And again, my name is Nick Schiavo, and I am an alumnus of Pace University. And it's great to be back. And I work with Bruce not only here but in other, in another organization. And it's the class is very lucky to have Bruce as a teacher. Today is part 2, is financial statement analysis, and that's exactly it. It's just the analysis. Before I start, just want everyone to know that any accounting or tax comments noted are for illustrative purposes only. If you're in your own business and an accounting or tax issue arises, you need to understand all the facts, the documentation, all the parties, the intent, and other things. So you got to look at that on a specific transaction by transaction basis. Today are some tools. However, when you drill down on a specific transaction, you need to look at it in a very detailed format. The agenda. Let's just talk with just a recap of last week, and then into the great stuff: financial statement analysis and other analytical tools. Q&A, and I'll be around after the formal session for a one-on-one. This segment is also being taped, and for those who are viewing it on tape, you have my contact information at the beginning and at the end of the slide. I'll be more than happy to follow up with anyone one-on-one to help them out. A recap of last week and where we are today. If you go down to 1, 2, 3, 4, the financial statements is our main focus of last week, where the balance sheet, the income statement, statement of cash flows, and our great equation: assets equals liabilities plus stockholders' equity. I mean, it is what it is. In any textbook, you will see that. You will see intangible assets. You will see goodwill. You'll see cash. Those are in any textbook. But what's very important in the actual business, that is important. But what's also important are, the infrastructure to support those financial statements. It is very, financial statements are becoming more complex. The business world is becoming more complex. And for the financial statements to be accurately stated, for you to produce them in a timely manner for investors, for you to make sure that you have the appropriate information so you can analyze it, which we're going to discuss today, to make sure garbage is not garbage in, which produces garbage out. You need a set of internal controls. You need a proper set of book and records. You need a financial reporting system such as QuickBooks, Xero.com. That was all discussed last week, and you can refer to the video on that. That's very important in today's dynamic business world. Just look at what's in the paper about some of these enterprise risk items that have occurred and resulting in financial statement issues. And it's self-explanatory what's actually happening. Okay, let's get into the great stuff and the financial statement analysis. And I'm going to go through many equations. Okay, but Bruce said it very well. What does this tell us? And that's exactly it. I'm going to flow through all of these equations, and you're going to look at and you're going to say, how does it apply to my business? In anything, anytime you're doing an analysis, you do the analysis, and then you get, well, I got these numbers. Is it good or is it bad? Okay, and that's what you're going to need to. That's what you should now say. Why? As Bruce stated, you got to properly manage your own business, but then you have the credibility with an investor, with a shareholder, with other parties. So what is financial statement analysis? It's one way to analyze financial statements. By rate, you can do ratios. Okay, we all know what ratios are. We've all taken the financial statement class and the accounting classes here at least. We know that. Okay, but by itself, you need to use a comparison. You need to use benchmarks. You can compare them with previous years. You can compare them to industry. And there are industry standards out there, and there's guidelines and there's databases, okay? So you can't just look at it by itself, compare it to others. And ask yourself the question, why? Okay? So utilizing these financial ratios, you can utilize it within the firm, within the firm and outside, and that's very important. So using it within the firm, and this is you as a business owner managing your business. And I'm not just going to read off these bullet points. It's pretty, it's on the slide, but again, you need to use them to just manage your business. And for an example, if your accounts receivable turnover, going up, and we'll get into that, from 30, 40, 50, you need to take action. And I'll explain to you why when we get to that, okay? But that's where we could say, that's an example of taking corrective action. The 1, 2, 3, the fourth bullet down, prepare at both firm and division levels, okay? So, if you have a business with multiple lines of business, and say you're in the furniture department, okay? And you say you're in the office furniture, right? And then you have a couple lines of business producing chairs, and maybe there's another line of business where you just consult because you know that specialty, and you're bringing on just consulting for office layout, okay? So, and then your other line of business is the actual manufacturing of chairs, and then chairs versus desktops, etc. You need to analyze these businesses, these products, by themselves and in total. Okay, for an example, so you have two lines of businesses: the consulting end and the manufacturing end. And that's your specialty, which is good. But say the consulting for some reason is got a low profit margin, okay, and the manufacturing has a high. Consolidated, you may see, well, I have a reasonable profit margin. Yes, you do, and consolidated you do, but you could improve your consulting business. And therefore, you may want to take corrective action and focus on that and see what types of improvements. And that's what I mean by preparing at both the firm and the division level. Outside the firm, okay, lenders, credit ratings agencies, investors, suppliers. So you want to apply to the bank for a loan. Okay, I am not a banker. I've never provided any lending, but from what I read, from what I hear, from banks you speak to, they use many types of tools, and obviously they'll look at your financial statements and provide and implement ratios. Investors. Okay, so you want to bring on you want to obtain outside capital, okay? So you're going to bring in a firm, maybe say a VC firm, and they will take your financials and they probably produce their own ratios, etc. But again, if you've been monitoring your business and managing it, creating your own and taking corrective action, there and using the proper ratios, their results should be similar to yours. So, where previously I said within the firm, there's also external parties, and for obviously external parties, you will need them down the road as you grow your business. Okay, now on to the nuts and bolts, and there's three broad classes of ratios, and one is determined the profitability. One is determined the liquidity, and the third one is determined the solvency. And that's using your basic financial statements that we discussed last week. So let's talk about profitability ratios. And again, this is just, the title is the title is self-explanatory. You really want to know, your company's ability to generate income. And you say, Nick, last week you talked about operating profit, you talked about net income, and I saw numbers. That answers my question. Yes, it does, and we'll get into that about comparing financial statements from quarter to quarter, from year to year. And that is one tool, I said, of many to utilize. Okay, but this is there's various ratios like operating return on assets, total asset turnover, return on equity, and I'll bring those ratios up, and they really focus on a specific aspect of your business. And remember, and I'll summarize this at the end, but when you're looking at a ratio, that's one of many tools that you will utilize as a business owner, or one of many tools an external party will utilize to determine the health of your business. Okay. So, operating return on assets. Okay, it's again, the formula is operating return, and that was sales minus gross profit. If you remember from last week, and over total assets. Okay, I just put these numbers in there. These are random numbers, and it's really saying, what does this tell me? That the managers, business owners, are generating 20.6 cents of operating profit for every $1 of assets. That's great. But again, you'll see at the end of each ratio, I have this bullet point, why? And that's what you need to ask yourself, why? What's our objective? To generate profits. I've accumulated all of these assets. What are they doing for me? Well, an asset should generate income. Remember, you own them. As we discussed last week, you own them. And so if you own an item, it should generate, and you're in business, it should be generating profit. So the higher it is, right? The higher it is, obviously I know I'm doing better. And think about it. So if this 80 million, right, was, 182 million, you probably get this to about 47%. Okay, so again, whether you look at it, just analytically, or you look at it from a calculation, again, the objective is to generate profits. And what I recommend you do is after we go through all of these ratios, is to put them on an Excel spreadsheet. What you would do is you put them on an Excel spreadsheet, and basically when you have your business, you're doing projections, or just play with the numbers on an Excel spreadsheet. Put them in various columns, and you'll see how the numerator changes and the denominator changes, and things will change, and you'll say, my assets decreased, my operating return increased, and you'll see, and that's a very good thing to just sit back and take a look at and say, okay, now I see how they work. Another ratio, total asset turnover. Again, it's how efficiently is the company using its assets and generating sales. Okay, again, high level, it's about profitability. How do we get that profit? Get that profit through operating profit, through generating sales. Okay, I have these assets, I put them to use. Again, why? What's so good about this turnover? Why is it good if it's high? Why is it good if it's low? Okay, one ratio, the higher you get, the better it is. One ratio, the lower you get, the better you're doing. Again, it's the interaction of your financial statements, the balance sheet, the income statement, and you got to say to yourself, what is the purpose? What is the purpose of these assets? What is the purpose of sales? What is the purpose of me as an owner being able to collect my accounts receivable quicker? What is the ability, if I take on debt, to make sure that I have I'm generating sufficient income to meet those, whether it's those quarterly interest payments. If not, what happens? And we'll get into the debt ratio. What happens? I may break my debt covenant. You've got bigger problems. Very important. Okay. I'm not trying to fly by these slides. There's many. I'm trying to give everyone just more of a high level and more what they need to think of as they utilize these tools to manage your business. Because we can always go back to these slides, and it's important, as Bruce said at the beginning, what does this tell us, and do I understand them, and can I converse this to whether I'm pitching to third parties, okay, and also most important, am I being honest with myself as you've invested capital in your business. Are you being honest? You've invested capital, whether it's financial and human. You want it to grow. You want to make money. You want to make smart money. Okay. ROE, return on equity. Again, we're looking at the comments. Net income. Again, it's just profitability ratio. So net income, right? We talked about sales. We talked about operating profit. What's the bottom line on an income statement? Net income, right? So what we did so those were the three ratios. Okay, so the three ratios were operating return, total asset, return on equity. We really took components of the income statement as a numerator, and then we basically put them over the balance sheet, which was the denominator. Then we asked ourselves, how's my business doing? How am I doing? What action do I need to take on that? Okay, the second major type of ratio is the liquidity ratio. And, I try to make this very simplistic. The firm's ability to pay its bills on time. Again, cash, remember we talked about last week, cash is king. You want to pay your bills, okay? Because if you don't pay your accounts payable, on time, your vendor's going to say why, and then if you don't pay them at all, you're going to have they may stop shipment. Stop shipment, then what happens? You're unable to sell product, and then you're unable to sell product. You're in a downward. Things go for loopers. Okay, so this is part of managing the business. Okay, there's generally four types of ratios: current, quick, accounts receivable, and inventory turnover. The current, okay, current assets, current liabilities, divided by current liabilities, which is current assets, cash, accounts receivable, divided by, let's just say, accounts payable, and the short-term aspect of debt, okay? So we're pairing cash and current assets that can be converted into cash with liabilities that can be paid within the year. So it's right, it's current. It's just my current assets and liabilities, which is the most liquid. The objective is to obtain cash. Get that cash from all your sales, from the receivables and payables that you accrued, right? And then you're saying, okay, I've received it, I made the sale, I've given 30-day terms, either in my sale or in my purchase, I can convert it, and now what do I do? How successful have I been? How have I been converting? Okay. The higher the ratio, that the more assurance exists that current liabilities can be retired, can be paid. Okay. Obviously, you want your current assets to be higher than your current liabilities. Again, the quick ratio is cash and accounts receivable over current liabilities. This is very liquid. Again, the larger the ratio, the greater the liquidity. So I've gone through about 5 ratios now, and you say to yourself, I'm going to go through many more, but think at this point, it's good to take a breather and say, well, which one should I utilize if I'm managing the ratios within the firm? And which ones do third parties use when they're analyzing my own firm? There's many. There's many. And one ratio doesn't tell the whole story. And we'll get into that. But think about that. It's just, again, with the spreadsheets, etc., you can do things very quickly, and just analysis. These are very good. Use them all to make a collective decision. Okay. So the next item is average collection period, and by that I mean the collection period on accounts receivable. Okay. So let's walk through the very closely, and I'll dissect this ratio in very detail versus the others, because I think we can all relate to it. And if you utilize this process on all these ratios, you'll understand how important it is to say, I understand what this ratio is and what the implications of a higher and lower ratio is. Okay? So we make a sale. Usually in business, it's not, it could be net 30 days. Let's talk about the typical business. Okay? So you make the sale, that's great, it's wonderful, the product's out the door, the customer is happy, and you're generating more sales, you're making more purchases to replenish the sales. Salespeople are happy, you as an owner are happy, great. But you need to collect. Why? You need to collect the cash. We just talked about, retiring liabilities. We talked about cash is king. You need cash to grow a business. So, you look at this ratio, and yes, the formula is accounts receivable divided by annual credit sales divided by 365 days in the year. Okay, so it's really my accounts receivable over my, daily sales. That's what we're doing here. I'm converting it to a daily. And in this example, it's 23.6 days. And let's just say typical industry where the terms are net 30 days. And that's good. I'm not going to say, look, that's okay. Okay, that's okay. If this was 53.6, you got to ask yourself, my terms are net 30 days. Okay, unless you're in an industry where it's a long sales, for some reason it's a long collection period. Okay, again, but let's just talk about the typical. I know this class is going out to many participants who may be in different industries. Let's just talk about typical. Okay, so you say, okay, I'm below what the terms I provided to my customers. I'm below that in terms of collecting cash. That's good. If say then you do a trend, right, and then next. For the first 6 months it's 23.6. Then the next 6 months it comes up to 34.7. And then say, another 6 months it's coming up to 40. Okay. You may have a problem. You could have a problem, and that's where you need to take corrective action. Again, if you're selling a product and tell a customer that you must pay within 30 days, that's what you expect. Why do you tell them 30 days? I know that's kind of the industry, that's typical average, but you're doing that because that's how you manage your business model, and your forecasting and your financial management is all based upon, quote, 30 days. Okay. Inventory turnover, again. So you purchased a product, right? You've purchased your, okay, so going back to the office furniture example, okay? So you're in the business of, right, one of your lines of business is selling office furniture, okay? So if you purchase this from the manufacturer, right, you've expended money, okay? And you've expended money, and there's a cost to that money, and now you want to, quote, sell it, okay? So again, if you can sell it quickly, then you're turning it over. In other words, you brought it in, you've paid money, and then really you've got the money back plus a profit by actually turning over the inventory. And that's again, understand the item, understand the product that's on your balance sheet. See, what do I want to do with it? You know, what's most advantageous to obtain cash, to obtain profits, and that's what the inventory turnover is. Okay. The third and last ratio is I'll call solvency. Okay. Now we're looking at, quote, you know, we're looking at on the balance sheet, we're looking at our debt, we're looking at our equity, and what are we doing here? We're describing a company's ability to meet principal and interest payments on its long-term debt. You know, some may focus strictly on the principal, like others may just focus on, you know, interest. So where have we come so far with this, you know, with this seminar? Where we focused on cash, we focused on, you know, sales, we focused on the operating profit, we focused on the current assets, current liabilities. So we focused on the aspects, right, more of the top level aspects, more of the liquidity aspects of the balance sheet and of the income statement. We now go to the component of trying to finish off the financial statements of debt we've incurred, okay, we've taken on to grow the business. Equity we may have issued to help us you know, grow the business. And you have to manage that properly. And I'll get into, and these ratios will bring that to life, okay? It's because I've got great sales, I've got, you know, a lot of current liabilities, well, I'm sorry, a lot of current assets. You've now made a strategic decision a while back to issue debt, issue equity. That's important to manage. The debt ratio, total debt over divided by total assets. Okay. Again, you know, what is the component? What is the component? And this is a good indicator of, okay, you know, I've got 48% of my assets are financed by debt, 52% by equity. Okay. You know, it's all, you got to look at your business where you are, but it just tells you, you know, and you've got to make this own decision on yourself. Where am I with my business? I have a significant amount financed by debt versus equity. You're just kind of asking yourself that question. Total liabilities to net worth. Again, so your relationship between the creditors and the shareholders' claim to the assets, right? If you have equity versus if you have liabilities, if you have debt. Okay. In this example, you know, the owners have a significant amount of at stake. Times interest earned, which I think is very important. Okay, again, you've taken on debt, and obviously when you take on debt, you need to service the interest payments. whether, let's just take it very specific, whether it's, I guess bring this very, very close, very, to drill it down, make it simplistic, a student loan. For individuals, it's student loan or a mortgage on a house. What happens if you don't service the interest payments, including the principal payments on the mortgage on your house, right? The bank could bring forth foreclosure procedures. So apply that to your business, right? Whether you may have personally guaranteed, or there was collateral on, or some assets of your business may have been collateralized to secure the loan. It's very important that, to take on debt, people argue yes, people argue no, but if you do, and you make that strategic decision, do I have the capability to service it? And over time, am I able to service? Am I able to service? Because again, ask yourself, what are the consequences if you don't service your debt? Foreclosure, taking of assets, and other measures. Okay, that just concludes, is more of the types of ratios. Okay, now there's, like with anything else, there's sometimes limitations, and as I said initially, that ratios aren't the only things that are utilized, and we'll get into other factors, but you have to take these ratios and say these are one component. You know your industry, you know your business, you know your division, you know the various products, you know the divisions within your firm, you know your customers, you know your employees. Again, you're the owner, okay? But there's various limitations, and you've got to use, so you use these ratios as one factor. For an example, it's difficult to identify industry categories or comparable peers. You may have such a unique business where, what's the closest thing to it? And you go to the library. You go online. You get these databases, and then you say, the closest. I'm industry A. Maybe A prime is the closest, and you use that. Okay, but you use that as just more of of some type of benchmark. And then you have to be careful because, again, if you're, it could be seasonal bias. So as you're doing a trend analysis, which we'll get into, be careful that there's a bias. It could be seasonal bias involved. Okay, and here we are, other analytical tools. I've just highlighted two, but I just want to let you know there are many other tools out there. Okay, probably spend the whole semester on drilling down on all types of tools. But one is red flag indicators, and the second one is horizontal or called trend analysis. And let's talk about the red flag. Red flags is basically related to looking at financial statements and then saying, are there red flags here? Okay. So, you're looking at financial statements and you're saying, are there earnings problems? Okay. Now, if you're looking at industry, and you're looking at a company, you could say to yourself, I know the widget industry in the past year has basically been very innovative and really, this company is and the earnings are low. Reduced cash flow, too much debt, overstated inventories and receivables. And then you get into more of the qualitative factors. Changes an audit report is dated late. For say a specific industry. Is that a problem? Sometimes no, sometimes yes. maybe there was an accounting issue, which would be, a significant accounting issue, which may have been, management and the auditors may have had just maybe, they were discussing, and it took time for more research, which is fine. And sometimes it really could have been an issue, which the auditors identified and required further, analysis, possible restatement. Bond covenants, again, it's not bad, it's not good. I mean, obviously, there are bond covenants if you, when you're issuing debt for obvious reasons. Look at the counterparty. But again, read them, understand them. Say to yourself, why? Does this make sense for this company? And those are the things, and if yes, you could say, okay, fine, normal part of doing business. If not, ask yourself why. Okay, the other part is called horizontal analysis, and by that means, think about a horizon, okay? So you're looking at financial statements for a company, and the greatest things to do is maybe look at, Microsoft, Google, GM, and if you go to their 10Q, right, you'll see the quarterly financial statements, okay? And you see, and they do an analysis, and that's very good to do too. Putting aside any seasonal, right, or if there is, tell yourself what's the change, okay? If on the 10Qs they do management discussion and analysis, which basically the company is doing this as horizontal analysis. The change from quarter to quarter was due to X dollars and X percent, and due to the following factors. The change from year to year was due to the following factors. And those are good. If you go to these, Fortune 100 companies, and you look at their go look at the 10Q. I mean, it's public, and look at their MD&A, and say how do they present? What are they analyzing? What do they have to say? And do that to you can say, these are good tools that they're using, or I see how they're explaining themselves. I see how they're managing their company, and utilize that to basically take those types of tools. Whether it's more on a more micro level, etc., and say to yourself, I'm going to implement this, and be honest with yourself, and and if you start implementing those, if you do the types of analysis, which is all ratio, it's ratio analysis, it's qualitative analysis, it's quantitative analysis, it's analysis of the environment, it's analysis of their products. If you apply that to yourself and be honest, you could say, this is great. I knew my company was doing well, and the numbers prove it. Or, yeah, I realized I've had a problem. And I'm being honest. And this really focuses, this analysis that I've done, and I was honest with myself, focuses on a specific issue, whether it's the ability to meet or not meet debt service requirements, or I have my accounts receivable collection is higher than what it is higher than what it should be, and I need to bring it down more, to generate cash quicker. Again, that will help you in terms of managing your business. Well, now I'm going to just turn it over to the audience, but I guess in closing, again, last week we discussed basic financial statements, the balance sheet, income statement, statement of cash flows, assets equals liabilities plus stockholders' equity. And this week, we took those financial statements and really then said, okay, applying these ratio tools to them and saying, what is going on with my business? How can I better manage my business? And again, there's other tools out there that you can also utilize and be aware of.